All right, welcome to The Explainer. Today, we're going to peel back the curtain and look past the charts, past the numbers. We're diving deep into what really separates the winners from, well, everyone else, the psychology of the market.
Okay, let's just kick things off with a number that should, honestly, make you pause. Some estimates say a staggering 95% of futures traders, they wipe out in their first year. Think about that. 95%. Now, this isn't because they didn't find the right secret strategy, right? This points to something way, way deeper. And this quote from the absolute legend Jesse Livermore, it kind of pulls back the curtain on the secret. He's not talking about being glued to the screen, frantically buying and selling. No. He's talking about patience, about conviction, about having control over your own emotions. He's talking about winning that inner game.
So, okay, if it's not about being the smartest person in the room or having the fastest trigger finger, what's the real roadblock? What's stopping people? Well, the whole field of behavioral finance has a pretty compelling answer. The biggest battlefield isn't the market. Nope. It's the 6 inches between your own ears.
This brings us to our inner saboteurs. And let's be super clear here. These saboteurs, they aren't some kind of personal flaw. These are actually ancient survival tools hardwired into our brains. I'm talking about cognitive shortcuts that helped our ancestors, not get eaten by a saber-toothed tiger. The problem is, those same instincts, they can absolutely wreck a modern investment portfolio. It's like we're fighting our own evolution.
First up, and this one is a biggie, overconfidence. You know that little voice in your head? The one that whispers, "Oh, I've got this all figured out," or "I'm definitely smarter than the average person," or my personal favorite, "This trade is a can't-miss sure thing." Yep, that's overconfidence. It's this powerful emotional bias that makes us think we know way more than we do and completely forget about the role of just pure dumb luck.
And this isn't just some abstract idea, right? This bias leads to very real, very expensive mistakes. Overconfident investors, they tend to trade way too much, and all those commissions just chew up their returns. They might pile all their money into 1 or 2 hot stocks, which is a recipe for disaster. And they almost always believe they can perfectly time the market's ups and downs, a game that, let's be honest, almost nobody wins consistently.
So here's a gut check question for you, and be honest with yourself. Have you ever completely ignored solid evidence just because it went against your investment idea? Because you just felt like you knew better? See, our brains are wired to look for proof that we're right. So when a trade starts to go south, do you look for objective reasons to get out? Or do you start desperately Googling for any piece of news that confirms you were a genius all along? That right there is overconfidence holding hands with its equally dangerous cousin, confirmation bias.
All right, our next inner saboteur is called loss aversion. And man, is it powerful. So the psychologists who figured this out, Kahneman and Tversky, they discovered something amazing. For most of us, the sting of losing, say, $100 feels about twice as bad as the thrill of gaining $100. It's a totally uneven emotional scale, and it completely messes with our ability to make rational financial choices.
Okay, so take a look at this. Which one would you choose? Option A is a guaranteed loss of $750. Ouch. Option B is a coin flip, a 50-50 shot of losing either $525 or $925. Now, if you do the math, the average outcome for both is exactly the same, a $750 loss. But guess what? A ton of people choose B. Why? Because they'll do anything to avoid the certainty of a loss. We will literally take on more risk just to sidestep the emotional pain of admitting we were wrong.
And this is exactly what loss aversion looks like in your portfolio. You know the feeling. You're staring at a stock that's down 30%. Your original plan was to sell if it dropped 10%, but you're still holding on, just hoping, praying it'll come back. At that point, you're not making a smart investment decision anymore. You're making an emotional one, purely to avoid the pain of admitting you made a mistake and making that loss real.
And our last saboteur for today is that powerful, powerful urge to follow the crowd, the herd instinct. This is what we call the follower investor. You know it as FOMO, the fear of missing out. It's that twitchy impulse to jump on a hot stock or a crypto that's suddenly all over the news, usually without doing any real research and totally ignoring your own long-term plan.
I mean, history is just full of cautionary tales about this. Take the South Sea bubble way back in the 1700s. People from every walk of life were throwing their life savings into this one company, all driven by pure hype. And when the bubble did what bubbles do, it popped. Fortunes were just gone. The public went from loving the company to pure rage. As one historian wrote, the name of a company director became synonymous with every species of fraud and villainy.
That's what happens when the herd stampedes off a cliff.
So, real talk. Has a hot tip from a buddy or some frantic headline ever made you just throw your whole plan out the window and make an impulsive trade? Just admitting that impulse exists is the first crucial step. It helps you build a defense so that your decisions are actually yours and not just a reaction to all the noise out there.
All right, so we've met our inner saboteurs. The enemy, as they say, is us. So what do? How do we fight back against these biases that are baked into our DNA? Well, we can't just wish them away, but we can learn to manage them. And we do that by forging a weapon, the mindset of a true professional.
And this right here, this is the critical shift that every successful investor has to make. Just look at the difference. The amateur mindset is all about reacting. It's driven by fear and greed. When things go wrong, they blame the market. They're looking for certainty in a world that has none. But the professional? They're proactive. They have a plan and they follow it. They take total responsibility for their outcomes. And here's the big one. They don't try to avoid losses, they manage them.
Now let's get one thing straight. This is not about becoming some kind of emotionless robot. That's impossible. The best traders in the world, they feel fear, they feel greed, they get frustrated, just like the rest of us. The difference is they've built a system, a structure that acts like a firewall between their feelings and their actions. They've trained themselves to execute their plan, period, regardless of whether they feel on top of the world or sick to their stomach.
So where does this discipline start? It starts with the professional's #1 tool, risk management. And it comes down to one single, non-negotiable rule. You have to define the rules of the game before you even put 1 cent on the line. Where are you getting in? Where are you taking profits? And, most critically, where are you going to say, I was wrong, and take a small, planned loss? This pre-trade plan is your shield. It's how you protect yourself from your emotional, in-the-moment self. And what's cool is that there isn't just one magic formula. Look at these 3 absolute legends. Mark Minervini, he varies his position size based on his confidence. David Ryan keeps it fixed no matter what. Dan Zenger bases his on the exact dollar amount he's willing to lose. See? Their specific methods are different, but the core principle is exactly the same. They all have a system. They never just wing it.
Okay, Section 3, the path to mastery. And the subtitle here is key. It's a journey, not a destination. So armed with this new professional mindset, with risk management as our shield, we can actually start walking the path to mastery. And it's so important to realize this isn't a finish line you cross. It's a lifelong process of getting to know yourself.
Think of these as the new rules for your brain. First, you take 100% responsibility. Your outcomes are yours. The market didn't take you out. No, your stop loss, which you set, was triggered. It's a subtle but massive shift in mindset. Second, a loss is not a personal failure. It's just a business expense. It's the cost of doing business in an uncertain environment. Reframing it like that just sucks the emotion right out of it. And all this leads to real consistency, which comes from discipline, not from trying to predict the unpredictable. And this quote from the great trading psychologist Mark Douglas, this really sums up the ultimate goal. It's about getting to a place where you've so thoroughly accepted the reality of risk that nothing the market does can feel threatening anymore. And if nothing is threatening, there's nothing left to fear. You can just observe the market and execute your plan calmly and objectively.
So in the end, the market is a powerful teacher. It can be humbling for sure, but more than anything, it's a perfect mirror. It just reflects back at you, your discipline, your fears, your greed, your patience, all of it, with no filter. The real work, the inner game, isn't just about learning charts. It's about learning about yourself. So the final question is, what will that mirror reflect about you? Thanks for joining us on The Explainer.